Markets crash. Headlines scream. People panic, freeze, sell, or simply hope it ends soon. And quietly, in the middle of all that chaos, new millionaires are being created. Not by luck, not by insider secrets, but by understanding something most people miss every time a crash happens. This matters right now because crashes are not rare accidents. They are a feature of the system. They arrive every few years, wearing different costumes, but following the same script. And each time wealth doesn't disappear, it changes hands. Let's rewind to a familiar scene. A market falls 30%. Portfolios bleed red. News anchors talk about uncertainty. Average investors think, I'll come back when things feel safe. That decision feels rational, emotional, human. But here's the uncomfortable truth. By the time things feel safe again, prices are already higher. Crashes don't destroy value evenly. They destroy confidence first. Prices fall because fear spikes faster than fundamentals collapse. Companies don't vanish overnight. Assets don't suddenly become useless. But the price people are willing to pay drops sharply. And that gap is where opportunity lives. Think of it like a clearance sale where only a few people are calm enough to walk into the store. Everyone else is running away, convinced the building is on fire. Sometimes it is. Often it isn't. The system amplifies this. During crashes, forced selling kicks in. Funds need liquidity. Leveraged players must unwind positions. Prices fall not because assets are worthless, but because someone has to sell right now. Urgency replaces logic. This is where the math turns uncomfortable. If an asset drops 50%, it doesn't need to double in value to recover your confidence. It needs to double to recover its price. That recovery usually happens quietly, slowly, and long before headlines turn optimistic. History keeps repeating this pattern. After major crashes, markets don't just recover, they overshoot. Because stimulus arrives, rates fall, liquidity floods in. The same system that punished panic rewards patience. But here's the catch. Most people can't act during crashes. Not because they're stupid, but because they're exposed. Their money is tied to jobs, EMIs, daily expenses. They don't have spare capital or emotional bandwidth to buy when things look ugly. The people who win are usually boring. They prepared earlier. They stayed liquid. They understood that crashes are moments of price discovery, not moral judgment. Popular narratives romanticize hustle during booms, but wealth is often built in silence during busts, not by predicting the bottom, but by accepting discomfort earlier than others. That's why every major economic crash creates new millionaires. Not overnight, not instantly, but inevitably. So the real question isn't whether the next crash will come. It's this. When it does, will you be forced to survive it or positioned to benefit from it?